And just like that, the week's about to get started. Let's get ahead and see what is going on. This is our little preview of what the week could possibly look like, and the start of it seems to be negative. So Tesla's down 1.22%, Nvidia's down almost a percent, Microsoft down almost 0.4%, Apple down point, Amazon 0.4 down, Meta down 0.3, about QQQ down about a quarter percent, down 24 basis points. Bitcoin's up on the day, TLT down 0.1%. Wow, what the drop. So there's a lot less negativity than a lot of people were anticipating to happen. Last week on Friday, we got an announcement that tariffs on steel and aluminum will be doubled from 25% to 50%. And I wanted to find out how that would impact things. So I asked ChatGPT, broadly, how does steel and aluminum prices impact the economy in the US? And then explain how tariffs getting doubled can impact things. It said, steel and aluminum are what economists call intermediate goods. They're not usually bought by consumers directly, but they're critical to producing the things consumers do buy, such as buildings, vehicles, so cars, trucks, semis, manufacturing appliances and tools, defense, so military equipment, consumer goods like cans, electronics, home goods. So it impacts an array of things. It really does. Everything's connected. Now, what do these tariffs being doubled really mean? Well, when the US doubles tariffs on steel and aluminum, here's what happens. So the intended effects protect US and steel aluminum manufacturers, make foreign steel more expensive, so it boosts domestic demand, it makes us more competitive, protects US jobs, help domestic factories compete and create US jobs. So we just talked about that. What are some of the unintended consequences, though? Well, companies that use this steel and aluminum end up paying more. Higher production costs equals price increases on these finished goods, so consumers start feeling the weight of that as well. US goods become less competitive globally, leading to lower sales abroad. Trading partners may impose counter tariffs on the US exports. Prices of goods rise, adding pressure to the Fed's inflation battle. Markets may sell off due to uncertainty or fears of a trade war escalation. Then it goes into some real world examples. And the bottom line, it raises production costs for key U.S. industries such as these two mentioned. These lead to higher consumer prices and maybe slower growth. And it might benefit domestic steel workers, but at the cost of inflation and global trade. Now, back to these stocks. I kind of thought about it, and we've seen this story happen before. So the first time with the tariff 1.0, we seen what was called a, what do they call, frontlining of tariffs, where companies were like, okay, these prices are going to go up, let's buy now, let's buy now. And we've seen a lot of more so retailers order up on all of these goods, so inventory's maxed out. They're probably not going to be buying more inventory for a while rather than sitting on the inventory. But during that time, it caused prices to go up because demand was higher to hurry up and get these goods before the tariffs came in. So it added some stimulant to those industries. And I was thinking about this as steel and aluminum because we've seen this story before and it's most likely going to happen again. Like, the past doesn't repeat itself, but it rhymes oftentimes. And with this steel and aluminum being front run, people loading up on it, then they're going to have this inventory of, say, steel and aluminum. And what's that going to really do? One, it's going to benefit prices. Well, it's going to benefit the companies that sell it. It's going to help drive jobs. And then people are going to have this stuff. Like, imagine you just got the ingredients to pizza sitting in your fridge. Eventually, like, you might not make a pizza this moment, but eventually you're going to end up making a pizza. And that's just a metaphor for the steel and the aluminum, because what kind of stuff? We just talked about it. Electronics, buildings, automobiles. It really helps drive the manufacturing side of things where a lot of workers could benefit in a way. Think about those are even some industries where you're able to get overtime because there are a lot of workplaces where you can get overtime, but there's a ton of industries that don't do overtime at all. Like you get your 40 hours a week, that's pretty much it. Like you're closed after hours. There's nothing else to do work wise. So this could really help these industries. And with the one big beautiful bill where they want to eliminate taxes, say if you make a certain amount of money, I believe it was under like 200,000 or 250,000, anyways, whatever that number was, it would be more so these factory workers that would benefit from this. So I was just thinking about this. Now, as far as stocks not really falling on it, like, yeah, this another tariff, but we've seen this here, and people are thinking that the stock market will just keep on kind of grooving through, the economy will keep on grooving through, mainly because what's priced into stocks on this article, I forgot to mention it, stock markets haul in May comes as tariff turmoil and job angst lurk on the horizon by Joy Wiltermuth. They mention in here that what's priced in stocks is US tariffs on imports will settle around the 10% for much of the world and 30% for China. If that level is maintained and we don't see it get worse than that, the markets have correctly rebounded because companies can manage that environment. The impacts of inflation will be less draconian. What the heck even is that word? I've never seen that. Draconian. And growth will remain positive. But you just don't know if that's going to be the real rules on the road. And they also went in to talk about how data is starting to disagree. Well, that wasn't this article that was talking about that. That's this article that the U.S. economy will muddle through Trump's tariffs, probably. And it started talking about soft data versus hard data. Soft survey data is still weakening, and we're getting good surprises only because expectations have plummeted. Meanwhile, the hard data on spending has been fine. And we'll go back to the stock market here in a bit, but I wanted to explain the difference between hard and soft data and kind of get these thoughts through, and then we'll continue down our little road we're on. In economic terms, soft data refers to subjective measures such as sentiment, expectations, and opinions, while hard data represents actual economic outputs and results. Soft data, often collected through surveys, indicate what people say about the economy, while hard data shows what they do. Examples of hard data include employment numbers, which we get this week, retail sales, and industrial production. So it's actual numbers, while soft data measures like confident consumer confidence and business sentiment, which it's really like, hey, this is how I feel about the economy, rather than actual numbers coming out. But some people say that this hard data is lagging and that the hard data that we're seeing is kind of out of whack because there's just so much drastic change, and then with the front running tariffs and how that's actually going to impact, do we ever see this soft data and hard data start align with one another? And that's what this US economy will muddle through Trump's tariffs article is talking about. The gloomiest interpretation of the gap between the soft and hard data is that the hard data is out of date. On this view, it is capturing the effects of the boom in inventories as companies stocked up ahead of tariffs, while the soft data captures the collapse in sentiment as CEOs, consumers, and investors anticipate tariff-driven price hikes and weaker demand. And let's just assume. So, with this other article, it said the market's really priced in 10% around the world, 3% for China. If that goes away, that's really good for stocks, right? But companies already started announcing like, hey, we're probably going to have to raise prices for these tariffs. If these tariffs go away, somehow, let's just say they go away, do they like, hey, just kidding, we're not going to raise prices on y'all, or since we're already kind of expecting it and we were okay with it in the first place, whether the soft data showed that or not, do they turn around and no longer need to issue these price increases? Like that kind of helps margin in a way, like what investors like watching. And a lot of people has been marking down what they expect company earnings to look like. So in a way, this could boost earnings, assuming the tariffs disappear with the increase in prices we've got. But we're anticipating a tariff-driven price hikes and weaker demand. So there's the second part, weaker demand. Assuming across-the-board tariffs survive the legal challenges or are reintroduced under laws, which we probably have seen the worst of the tariffs, and maybe there's a combination, a middle ground in the middle of the road that we can agree on, where like we said, like the 10% tariffs, rather than you get 125, you get 50, you get 40, you get 35, like a baseline 10%, and then maybe a couple extras here and there. But a combination of delayed capital spending and expectations of higher inflation could easily start to show up in weaker spending and job losses, hurting the data. And this is why the labor market's so important to watch, because all of the money that we've been seeing go into stocks and allow them. Let's zoom out more. Let's go on the week chart. We're near all-time highs all over again in these markets. Look at the top 100 companies. Near all-time highs all over again. Nvidia, near all-time highs. Microsoft's right there at an all-time high, knocking on the door. So this is where the monies came from for people to be able to buy these stocks back up. Are jobs. I still have my job. I could still save a little bit of money. I could still buy stocks. So these job numbers are really important in what people are watching. Now, the basic theory is shown in watching leading and coincident economic indicators. The leading indicator has slumped to its is close to warning of an imminent recession, while the coincident indicator suggests that growth is grinding on regardless. Put simply, it might look sunny, but there's a storm on the way. Now, economic surprises on soft data is at a high. It's on the higher side. Hard data on the higher side. So people are starting to feel better about the economy, which is what I'm looking at, because look at the Liberation Day tariff announcement line right here in the middle. Soft data, which was people's opinion, oh man, it's going to get pretty tough out here, went to its all-time low around April 17th, and it's just been straight up since then. And the hard data has been looking good, and especially with this is probably where we started to see the pull forward in purchasing and driving sales due to the tariff expectation. And everything's just kind of been looking good lately, and soft data is catching up to that. But this one was just talking about the leading coincident and the economic indicators. So let's scroll all the way down. Right here, the fear versus the US economy. The leading indicator is right there at negative 0.5, which is a recession warning below here. And we're right there at the line where if we break under that, that's a recession warning for the leading indicator. The coincident indicator still looking good. Let's do another search on this one. Fear versus the US economy. Coincident versus, what was the other one? Coincident versus leading here of fear versus US economy. Coincident indicators reflect the current state of the economy, while leading indicators predict. So, I mean, that makes sense. I was wondering if I had specific examples, though. So, leading with examples, the Conference Board's index of leading economic indicators, role businesses, investors, policymakers using indicators to forecast future economic activity. So, coincident indicators change roughly at the same time as the overall economy. They provide a real-time snapshot of the current state of the economy. Industrial production, manufacturing, and trade sales volume, and personal income. So coincident would fall more with hard data, and then the leading data would be more soft data. So okay, that makes sense in a way. But I put less weight on the weak soft data than the bears and less weight on the strong hard data than the bulls. The US economy can probably muddle through so long as the government keeps out of it. We got another truth from Donald Trump today. If the court somehow rule against us on tariffs, which is not expected, that would allow other countries to hold our nation hostage with the anti-American tariffs that they would use against us. This would mean economic ruination of the United States of America. And then we're going to be back to stocks after this. This made me think of a couple things. One, that all of these other countries are now, assuming Trump's tariffs get banned or deemed illegal or whatever, Trump, my guy, like, we were good. Everything was completely fine. And then out of nowhere, my guy, like, I thought it was just weird how out of nowhere you just raise these crazy high tariffs on us. Like, think about it from China's point of view. So a lot of these countries might still be salty and retaliate in a way. And that's what this made me think of, with them holding our nation hostage with anti-American tariffs that they would use against us. Like, he's maybe predicting and in a way saying that they're probably going to retaliate. And then also, this would mean economic ruination of the United States of America. Maybe, like, there's hints here. Like, is he hinting at a possible recession and kind of scapegoating, like, hey, it's the court's fault now? Like, I tried to help. And some people are even fans of Trump using this as a way to walk away from tariffs. Like, oh, I tried, but they stopped me. The courts, they stopped me. They made it illegal. And, blaming it on that for the economic ruination of the United States of America. So us going into a recession. I just thought this post was interesting to read because of all the hidden meanings that could be in it. And if you're hinting at anti-American tariffs that they would now use against us as retaliation, is that where a real trade war starts? So this is why I'm watching stocks, and especially this week and the coming months as all this stuff rattles out, because we're near all-time highs. We were just looking at those charts. And, this could be just a little breather. Trump announcing the 50% in steel or whatever, which is going to pull forward in steel and help kind of expand the economy in the short term, but maybe slow things down in the longer term. And as we go into a trade war, the stocks at all-time highs, it all goes back down to jobs being the spotlight, because assuming jobs hold up and people are still saving a little bit of money, consumers are holding up pretty well here in the US economically and financially, things keep going pretty smooth. But if any of that starts changing, this breather that we're talking about, it could be a lot longer and last a lot longer than we've seen. Rather than, how long did it take for us to rebound? So we were at a high around February 20th. We're at about a low around April 7th through the 10th. April, May, June. So 2 months, and we're up like way higher than where we were. Just 2 months on a dip, that's not that bad. But what if we go back to times where in the market it took several years to break even, or several years, like a lost decade of gains in stocks, and it took 10 years to break even? That's not unheard of in financial markets. There is more risk associated with these great returns in stocks. And to think about it, stocks have been performing very well. 25% a year on the average stock market? How long could that happen? I thought the average was supposed to be like 8 to 10, maybe 12%. We've been like 20%, 25, 22% for like 4 or 5 years in a row now. Pretty much since COVID. So how long is that able to keep on going through? At least with a year where you ended negative, like the Nasdaq's barely down 1% or it's up 1% or something. Like, it really hasn't moved. And considering all the chaos in the market, it seems like it's back to that taco trade. The taco trade, Trump always chickens out, so people just buy the dip regardless. But what if we did go into a scenario where it just takes a little bit longer to get our footing on the ground. And I'd imagine it's where there's a trade war or some type of war. And overall, wars are unpopular now. Like, everybody's more aligned with peace. You don't want to go like shooting up a spot, although it happens. But war now, at least in my opinion, would be like these tariffs, or like competing in technology and holding certain assets from other countries, like stuff regarding trade, right? And technology, marketing, buying their treasuries. But I mean, I'm still learning. Um so this week we got a big one coming. We got, let's pull up back over here on Market Watch. Like I said, job numbers are what a lot of people are watching. And although job numbers are probably going to look pretty good, it's not giving me the little chart. So just pull up the economic indicator. Calendar report. This week, we got a ton of Fed speakers. We got construction spending. That's a big one. Auto sales, job openings, factory orders, ADP employment. This one's a big one. Fed Beige Book, initial jobless claims, U.S. productivity, and then Friday, all types of employment reports and employment data, U.S. wages, hourly wages, consumer credit. This week's a big week because it gives us insight into how these jobs are holding up. Because this right here, this stock market we're watching, it's all predicated on people being able to buy the stocks. And where do people get money? Let's go back, y'all. Their jobs, their employment. And as long as this employment's holding up pretty well and sound, that's good. But if, due to whatever factors, oh, this is interesting. Fed Waller sees a path to multiple interest rate cuts this year. Let's look at this article. Let me read through it real quick. Because assuming all of this mess that we've had going on just goes away and people still have their jobs, and then it's a clear path for the Fed, then interest rates could get cut, and then we're back to smooth rolling. But assuming there's uncertainty for longer and we still got trade wars ahead of us and stocks are at all-time highs, it's just a weird spot, right? It's a really weird spot. So the Federal Reserve will likely be able to lower rates this year, and recent data supports this outlook, Fed Governor Christopher Waller said. In a speech Monday morning in South Korea, Waller argued that inflation from the Trump administration's higher taxes on imported goods would be persistent. He said that consumers are not acting as if they were worried about higher inflation, despite recent polls saying they expect short-term inflation above 6%. So this goes back to the hard data versus the soft data, which we just learned this together. Look at that. We're learning. Assuming that the effective rate of tariff settles close to the 10% and that underlying inflation continues to make the progress of the Fed's 2% goal, the labor market remains solid. I would be supporting good news regarding rate cuts later this year. A good news rate cut means the Fed can lower rates because worries of higher inflation have eased. A bad news rate cut would come from a clear economic downturn. Okay. So he's saying good news, we're cutting rates, but usually there's times where the Fed has cut rates and it was due to bad economic reasons, and people's talked about the comparison of when the Fed cuts rates, and usually it's because of the reason why they're cutting rates that is so damaging to the economy. That's when jobs are doing bad, or the stock market's going through a recession, or like the subprime mortgage collapse to save the mortgage industry and the real estate bubble that formed from giving out risky subprime loans. The Fed lowering rates was to help stimulate the economy to prevent things from getting worse. They're saying here that a good news rate cut, hey, we hit our 2% goal, let's go, we're just going to cut rates now. He's saying it's more so that. Waller said a 10% average tariff rate would only mean modest job losses for the economy. So they're expecting some job losses, but hey, it's not going to get that bad, is kind of what he's saying. In his remarks, Waller said the recent hard data pointing to a solid labor market and gradually slowing inflation gave the Fed additional time before making gives them more time before making the decision. The next meeting we got is at June 17th through the 18th for the Fed. And let's pull up the CME Fed Watch tool real quick. We're right, loading in there. And my nose itches. So that's in 16 days. We're at a 95% cut. What everybody's watching is September because that's when they think the first cut will come from after us just sitting steady, not cutting rates for a while. So this has went up quite considerably. This was below 50 not too long ago. You could see it in one of my previous videos. Then it was at like 50, then like 51%, and now it's at 57%. So people starting to mark back in the, hey, the Fed might actually be cutting rates, and look, it's because of a good thing. Oh wait, it's because of a good thing. Where's it at? Oh, right here. A good news rate cut. Wonder if when did this article even come out? June 1st, 8:21 p.m. How's that even possible? It did say he was in Korea though. Okay, not too long ago. Are stocks doing any better from that news? QQQ and everything's still pretty in the red territory. Nvidia's kind of gave back some of them losses, so all right. But back to this Fed stuff. Let's go back to this Waller right here. Right now, PCE's kind of coming closer to the Fed's target. It's looking good. But remember, economists are expecting the PCE, the Fed's preferred measure of inflation, to start trending up more in the summer. So anything could happen, and then breaking Fed so and so sees path to multiple interest rate cuts much lower due to increasing inflation, and then that'll still be bad news, and then a cut could get depriced. So that's really the trouble of looking out and trying to forecast so far away, because so many different things could happen between now and then. See where we're looking for December 10th. The highest chance, 40.3%, is 2 cuts still. That's at 40%. So it's not even half a percent yet. But a little less than half a percent, 40 basis points. Or is this, yeah, 40 basis points. The way to say that. Or would that be 400 basis points? I guess 400 basis points would be 400%. I mean 4%. So 40 basis points. Maybe I'm not saying it right. I'm just learning. But I digress. This is an interesting time to be learning. Where are my little lines at though? Oh, I'm not even logged in. There's like a line like right here, like 510. I think I got it about 510, 512. So maybe we fill the gap and go back there. But then there's another line down here at like the 480s. And I seen somebody else. I watched a video today from somebody else in the finance industry, and he had those same lines right there. So it's an interesting watch. And he said that, hey, it could happen this week. It could happen 6 years from now. I don't know. But I'm just watching these lines. And with all the uncertainty going on, I think that just adds to the wild moves we see. So y'all, hope you enjoyed this video. Hope you have a great week. And I'll be back next time. Have a good one.